Hello ladies and gentlemen, welcome to our webinar today. I'm Joseph Novichkov, Senior Trading Manager for GDM. As a part of our trading system today that we will take a look at, I need to mention that it's quite suitable for all volatile currency pairs. As per request from previous sessions, today I will start with a different currency pair. We will be talking about the USD JPY. Furthermore, down to our road, we are going to work with the usual Euro USD, GBP USD, so on and so on. We might be able to take a look at the USD Canadian as I've been preparing. First of all, for this particular strategy, we will be using 5 different exponential moving averages and a relative strength index. This particular system is based on 2 popular indicators, as you already know, EMA and RSI, which of course are incorporated into all trading platforms, not only the MetaTrader 4. That's why it allows this particular strategy to be used in different platforms, which in most cases don't contain anything else, rather Bollinger Bands, moving averages, relative strength index, and those simple indicators that are widely used. The strategy is rather profitable if applied correctly, of course. It's recommended to use this particular strategy on 1-hour chart, and of course on volatile currency pairs such as Euro USD, GBP USD, USD JPY, so on and so on. The initial setup are the 6 indicators, which by all means I've already prepared for you as an additional template, so we don't lose time and of course interest into preparing the whole template. As further into the session I will explain in details what is the setup and why I chose those particular time frames and of course periods for the indicators. So let's take a look at how it looks. This is the way the setup looks like. However, it's far away zoomed in, and as you can see, if you're looking at it at a different perspective, this particular setup will be less visible and less understandable from your point of view. So for all traders, it would be much better if you zoom it in so you can see at what point of time the moving average is crossing another one from a higher level, and of course what it means. So we're using, let's take some notes here, we're using the 80 period moving average, which is the green one here, to measure the trend and of course to identify the trend in a long term. When of course the price crosses upwards over here of the green one, which is the 80 exponential, it signals of course an uptrend. The downward crossing is signaling a downtrend, of course. What else we're using here is the 21 exponential, which is the red one here, 13 exponential, which is the blue here, and now the indication of those two are the direction of the current trend, the trend that we're interested in. As we already know from explanations, if the small one, the 13 exponential, crosses the 21 above, the current trend is bullish, otherwise it's bearish. Relative strength index reflects and shows oversold and overbought conditions of the current market, as we know, and we're using three levels, 30 and 70 as the overbought and oversold, and of course 50 as an identification and a trigger point on our entries. Of course, this is pretty much a guideline to our rules. So let's talk a little bit more about the basic principle of this system, which one should understand quite well before trying to apply it. This particular strategy is designed to work on trends, and it will not work on sideways markets. You all guys need to remember that. So the entry conditions, so let's talk about the entry conditions here. For entry conditions, the first rule would be moving average with period of 3 and moving average of period of 5. The rest two moving averages which we have here. Now the moving average 3 must cross the moving average of 5. If, of course, we're looking for long orders, it should cross above. From the bottom, during the uptrend, it should cross to the upside. This is our first cross here. Number 3 crosses with period 5. Rule number 2, moving average 3 and moving average 5. This is the second rule that confirms our long position, that we should stay in it. Moving average 5 plus 3, they cross the channel of moving average 13, which is, as we already know, the blue one. And as we can see, the crossover of the channel of it is over here. Somewhere here is the crossover of the whole setup, and should we say the channel cross comes right over at this point where we have the first crossover of the two moving averages. What I mean by channel means that let me just put it a little bit differently so you can understand it. So we have a channel confined by the exponential of these two moving averages. So this here is a channel. There is always a middle, and this middle is crossed even prior to the crossover of those two. However, our confirmations need to be pretty much aligned one after another, so we can have a better confirmation of our future entries, and of course how long should we keep our positions valid. That leads us to believe that we need to take a look at also rule number 3, which is the relative strength index with period of 21. I'm just going to set it up here so we don't forget. Period of 21 is above level of 50. There's level 50. In this particular timeline, it's just crossing above the level of 50. And there is the fourth rule, which in most cases, if everyone wants to be, should I say, more conservative to this particular strategy, should always have in mind. And this is an except, should we put it with a star here, it's a rule that we can rule out from some time to time, depending on whether we want to risk more or less, risk less. And as we already know that we're talking about trends in this case, we need to have the price above moving average 80. The price should be always above moving average 20. So if you are going to enter, it should be somewhere around here, if you want everything to be perfect, should we say. Or if you just want to rule out the whole situation here, because as a conservative trader I would pretty much try to do so, because this setup here is too risky, moving along with the 80 moving average. It's a little bit too risky, but still, if you are going to consider entering in more riskier situations, then you can rule out rule number 4 here and only guide yourself through the crossovers of these moving averages plus the relative strength, which definitely needs to be above 50 in this buy situation. And of course, should we say for sell orders is vice versa. Of course, along today's session, we will have a look at different currency pairs, different situations, see how it performs, to see much more situations in the history, of course, to be a bit more certain that it's working. And as I mentioned about this particular sideways, as you can see here and here, between this range, the price is confined between a price to the upside and a price to the downside, definitely ruling out all other possibilities of trading this particular way. As you can see from here to here, we are seeing the relative strength index moving above and below the 50 level here and there, which means, of course, that it's not the best strategy for sideways range, but still we do have others that we already spoke about, other strategies that we can use on a sideways range. Right now we're focusing more on directional trends. As we already know, moving averages can be always only pretty much used on directional trends. Let's take a look at one more time at the rules before I clear this out and scroll forward or backwards to take a look at different situations, some more short and long positions. First rule, moving average 3 should be crossing over the moving average of 5. You know, these kind of ways of trading are widely known. However, this particular package setup is only for 1 hour chart, and it works great. It has wonderful results from a perspective of, should we say, eliminating a lot of false signals. Moving average 3 plus moving average 5 has to cross over to the above the channel of moving average 13, which of course gives us a secondary signal here by crossing over 13 moving average and above for continuation of this particular current trend. What we need to look for is relative strength, which is the 21 period should be above 50. And of course, here we can also add the moving average 21. So basically there is 2 ways of defining this second rule. One of the ways is if you have too many moving averages and it's getting too crowded on this chart and you have difficulties in finding your way around, you can always eliminate the 21 and always use the 13 as a main confirmational signal. However, if you are a bit more conservative, this is a good way to have more confirmation when moving averages converge in one point over here, giving you a better signal, much better entry over here. So as you can see, this is a very flexible strategy. You can pretty much modify it by your choosing, but essentially the rules must be followed in order for you to make the profits that you're looking for. And rule number 4, optional also for depending on a conservative or riskier trader. We have the price has to be above moving average 280 for the current trend to be valid long enough for you to make the profits. And speaking of which, let's take a look at what kind of profits we would make. Based on the fact that our exit points should be always over here when moving average 3 crossovers with moving average 5 to the downside. It's quite expected, of course, when they intersect one more time to a move to the downside. The faster moving average will intersect the slower one, giving us exit. This is the absolute must. You don't wait for too long because your profits will be erased. If you're a conservative trader and you've entered here, if you wanted the price to be above this one and all other crossovers to be done properly as well, your future profits would have been pretty much 26 pips in about 9 hours. This is for the conservative trader. And the riskier trader so far would have made about 50 in 10 hours. So that means either $260 in 9 hours or $500 in 10 hours. It would be better in most cases to be safe instead of sorry because of the losses that you might sustain. So it depends on what kind of equity you have and your availability to trade more riskier or not. This is for you to decide, and I'm only giving you the options. Me personally, I would definitely take the riskier option here as is for a bigger profit. You know, if for some case the price turns against me, and I can see that over here, where's my entry, pretty much when the price closes, I'm opening on the next opening, and you can see a long shadow here that is retracing to the downside before the price moves up, tests somehow the previous candlestick. So my stop loss should definitely be somewhere, should we say one more time, 5 up to 10 pips below the previous candlestick's low, which is the shadow is here, and your stop loss is 5 to 10 pips away from this shadow. And as you can see, the next retracement is even higher than the extremum of the previous session. Allows us a few buffers here to set up our stops accordingly, and this is pretty much the whole setup of the system. You have an opening, you have a close, and you have a stop. Pretty gentle system by my count, can be used widely by advanced or by should I say beginner traders. One thing is for sure, for beginner traders, the discipline should be a very, very serious matter that needs to be discussed. And as you already know, you can always count on us to assist you on all matters with additional educational material if you need to read at home comfortably, or sessions on a more private basis. So let's erase all this and take a look at the chart forward and backwards, see how it behaves around this particular system. Then we're going to switch through different charts to see other volatile currency pairs and the way they're behaving around with the same system. If we have to move forwards, we can see that this trend continues after the crossover of these ones, but still here we have additional confirmation for a further upside. We have it, and then we have another close. So you can see in a matter of a few hours you're able to make multiple positions with the system. The only thing is that to protect ourselves, we need to always close our positions when those two moving averages intersect. That's the 3 and the 5. When they intersect, we have a close. When they intersect here, we have an opening. Of course, along with other rules that we discussed a few minutes earlier, but as we can see here, everything is kept. The price is above the 80 exponential. It's crossing over properly above the 5 and the 13, and our entry might occur somewhere around this doji, where our close should be somewhere around here. The profit is a little bit too small for this case here, only 4 pips. It's nothing major. Therefore, we should try to pick different situations to have a bigger profit. Or other way said, if we have the possibility to zoom in, further in, we will see that those are not actually intersecting, but only a bounce off, and the intersection is actually here. This is a clear intersection. So sometimes the chart itself cannot really give us a much better view of the situation. That's why we can only adjust our indicators to the situation. As you can see, when we make it a little bit thicker here, now we can see that there is no crossover. It's only a bounce off. So basically this situation is still valid, and with our entry here and a close somewhere here, should I say, if you got nervous or something, or just waited for the next one to open, which is with a huge gap, you have about 40 pips of profit for about 14 hours. So this is another $400 with one lot traded. And based on your equity, you might be able to trade with even a bit of a heavier lot in this case. However, another exception here is a situation when we have situations like this one, strong retracement down, making those two to cross over, and then to cross over one more time. This is pretty much another entry, but when you see that, this is the exception where you can still stay in for a bigger profit. Now, this is more of a riskier way, of course. That's why I would pretty much suggest exiting somewhere here around this one. Doesn't matter if you just lose a few pips, a few tenths of pips, even though you still have your profits. Better be constant instead of losing more than half of your profits on the next day, or even your full profit and just scaling back with one step, which is not going to bring you closer to those profits that you're actually looking for. And another thing that we forgot to mention, it's the relative strength index in this situation is staying above the 50 level, which also tells us that the trend is valid and is going to continue to the upside. Definitely a good position. Let's take a look at some short positions. Now, For short positions, as we mentioned, it's vice versa. So situations like these, we pretty much are trying to avoid, as we can see here from this particular moment until this particular moment here, when we had a strong up and a strong down with more than 100% retracement, the price is staying above the 50 level. So we cannot really talk about short positions in this case. For me personally, it's too risky, it's uncertain. We have the 80 moving average still below the price, which we need to see it above the price if you're talking about short positions. And you can see for a long time we have a sideways range, then the price keeps going up. So when we are talking about sideways range, as in a case like this one, from here, first swing high, then swing low, another swing high, swing low, swing high, swing low, we don't really have a trend. So those moving averages are pretty much pointless to use, and that's why you have so much intersection. And this you can define by looking at the 50 level of the relative strength index. So in a sideways range, we're looking at different currency pairs. And our crossover should happen in a matter of steps. First, number 3 crosses number 5, and then both of them cross number 13 and then number 21. And then we're looking at relative strength index and whether the price is above or below the green one, which is the 80. Now those steps, when they're followed exactly, only profits will follow, nothing else. And as you can see here, we have it again with steps if we can zoom in, but this is the far and most biggest possible way to see the chart. You can see that they virtually cross over in one point, but it's not exactly like that. First, the moving average 3 crosses moving average 5, then both cross 13 and 21, and then they move up. However, your entry should pretty much occur somewhere in this candlestick, but you have no idea, so you're more of a conservative trader. You want to wait for another one, and then you have to enter over here on the opening of the next one, which means you're actually taking all of this move down to here, 78 pips in about 6 hours time, which is a very good option. And as we know, relative strength index does not really react well with trends, so all of those overbought and oversold conditions, they don't really matter when we're talking in a matter of trends. They only matter when we're speaking of sideways range. So the only thing we need to know is that the price and the RSI are above level of 50 to confirm that the level, that the market is in fact trending. So it doesn't really matter if we have some extremes here. You know, you can see that it still stays above this level of 50. And the only way it falls down is just when it's trying to test the 80 moving average, which of course eventually it appears in a sideways range for a very long time. Here we can even squeeze it out a little bit. But over here now we can talk about some really good positions for a downtrend. There it is. The sideways range is over clearly. Can't really zoom it in that much, but you can see how the crossovers are made by steps. 3 crosses 5, both cross 13 and 21, and so on. I believe you all got the point. Now let's take a look at some other pairs. Here we will be looking at the Euro USD. I already have it prepared. As you can see, pretty much the same step here for long positions. Everything happens in steps. The price is above the 50 level, above the 80. And we should take some steps back so we can see. because it's been a recent downtrend and it's still downtrend on the euro-dollar, so we can't really talk about any long positions for some time now. However, what's visible here is the same crossover. Virtually it looks like it's in one point, but it's not. It's happening in steps. So if you are able to look at your monitors a little bit closer, you will see that everything happens in steps, and it cannot be any different logically, because we're talking from a smaller to a bigger and much bigger moving average in period. So it cannot really happen in one point unless they are all, should we say, with the same period. So it can't really happen. You can see that it's intersecting in one point, but virtually with milliseconds or just a few fractions of a pixel, should I put it this way so you understand me, they actually cross over in steps. So in so strong moves, that's what occurs, but in a smaller manner of speaking, as you can see here, is a better explanation how it happens in steps. This is the more appropriate way of seeing it. This is what it looks like when we're looking at it over here, for example. All right, but as this particular moment is pretty good for, should I say, riskier traders. But still the exit rules, they should apply with no exception whether you're risky or a conservative trader. The very simple why is this situation here. If you ignore the 80 and you want a counter trend trade, then you will have more than 100% retracement. You will hit your stop loss, and it will be just a loss of time if you have a stop loss. But what if you don't have? So please use all those functionalities of the MetaTrader 4 only for you to be safe. Let's take a look at more situations. We have a very good trend here. It all begins somewhere here when everything is intersecting. Still you can see multiple exit and entries, no intersections here. The intersection comes even down here. So this is a position that gives us about 154 pips of profit, $1,540 with one lot for 26 hours. Well, that's pretty much one full trading day from end to end for all sessions. Gives you a nice profit, because when those really cross over here, as you can see, that doesn't matter. That doesn't mean that the trend won't continue. They're just too fast to give you something for a longer term. And for the longer term, you can look at the rest of the moving averages. They are intact, only tested with some shadows here and there. This is the our so much lovable 21 period moving average. Well, I believe enough examples for today. You all got the picture of this particular system. It's not so difficult to memorize and follow the rules. You will have the recorded session uploaded in our YouTube channel anytime soon, and you can review one more time if you missed any part. Well, that's all for me for today. So the next time we will meet will be next Wednesday, next week. We will speak about another very interesting 1-hour chart strategy, which you can pretty much combine with this one for a better certainty, but I wouldn't recommend it, as we will enter in the mode of one of the psychological levels that we actually spoke about. I'm not going to go too into it, so don't look for too much confirmations, because you will lose possibilities. That's it. Everything has to be balanced. Thank you for joining us. I'll see you next time, and with another 1-hour trading system. See you next time. Bye-bye.